Good afternoon, everyone. It's September 6th, 2024. Hope everybody had a good Labor Day. Today, after the market wrap, we're going to talk about I just inherited an IRA. Now what? I'm Steve Herwire, owner of Herwire Financial Plans with Direction. Okay, so we start with a tragic event. Someone's died, and now you find out you have inherited an IRA. Sounds like a really good thing, at least from a financial standpoint, but if you don't treat it just right, you can find yourself in a mess. So anytime somebody dies and leaves a traditional IRA to a beneficiary, it is complicated. First thing you need to do is determine if the owner of the IRA that you inherited died before January 1st, 2020, or after December 31st, 2019. You need to determine if they were the original owner of the account and need to determine the relationship between the owner, which is now the decedent, and the beneficiary. If it's a spouse, it's generally less complicated. But if it's not a spouse, we need to determine if the beneficiary is an eligible designated beneficiary. Next thing we need to determine is if the owner passed away before their required beginning date, which means were they required to take money out of the IRA or not? That's the required beginning date. And all this information is critical to determining the maximum length of time for disbursement and payment of associated taxes. Of course, you can empty the account quicker if you like. Okay, first let's talk about the most simple one. Inherited IRAs to spouse. Was your spouse the original owner of this traditional IRA? Did they pass before the required beginning date? Are you 59 and a half or older? Is the beneficiary older than your spouse? Does the beneficiary want income now? These questions are integral to determining which option is best for you, which includes rolling it into your own IRA or making it your own, or you can begin taking RMDs with no penalties, especially important if you're younger than 59 and a half. Okay, so suppose the IRA you inherited was from someone who inherited it from somebody else. Again, that all-important date, December 31st, 2019. Did people pass before or after that, whether it's the original owner, the most recent owner? Of course, we're going to talk about whether or not the original owner passed away on or before their required beginning date. Was the most recent owner an eligible designated beneficiary? The answers to these questions will determine which of the following paths you can/must take. You might be able to be on a path where you take RMDs over the original owner's or most recent owner's life expectancy. Anytime we're talking about life expectancy in this context, we're talking about the IRS single life expectancy table. And you might have to take it out over 10 years, and there may be RMDs required over those 10 years, or you may be able to take it all at once. Again, not very simple operation. Now, you may ask, who is an eligible designated beneficiary? Number one, the minor child of the owner, or if you are less than 10 years younger than your original owner. If you're disabled or chronically ill, and this eligible designated beneficiary, if the owner of the IRA died before January 1st, 2020, none of this matters. Okay, now, if we're passing from an inherited IRA's original owner to an eligible designated beneficiary, means the person who had the IRA before the death was the person who originally funded it. They didn't get it from somebody else. Again, we're looking at that all-important date, December 31st, 2019. We're also looking, did they pass before or after the required beginning date? If they passed away before the required minimum or beginning date, you've got to take RMDs over the longer of your life expectancy or the owner's life expectancy. If no, you may follow the 10-year rule where, and in this case, the 10-year rule does not require RMDs, or you can take RMDs over your life expectancy. Now, if you're required to take the RMDs over someone's lifetime, like I mentioned before, again, we use the IRS single life expectancy table. In this case, the 10-year rule is the deadline for emptying the account. In both cases, the starting point is the year after the death of the owner. And if the owner was required to take an RMD in the year of their death and did not, you got to take the RMD for the year of death also. Okay, inherited IRAs from the original owner to the non-eligible designated beneficiary. Again, we focus on two dates, December 31st, 2019, and whether or not the owner passed away before or after their required beginning date. If they passed away before the required beginning date, again, it's RMDs over the longer of the beneficiary life expectancy or owner's life expectancy. That's how much you've got to take every year. But in addition, you've got to follow the 10-year rule, which means in addition to taking RMDs, the account must be empty by the end of the 10th year. If no, you can take it out any way you like as long as it's out in 10 years. And in this case, the 10-year rule is the deadline for emptying the account. Basically, if it's 10 years after and you haven't emptied it, there may be a problem. And in both cases, the starting point is the year after the death of the owner. So if the owner died in 2023, 2024 is, year zero. You start at the beginning of 2024. If the prior owner was required to take an RMD in the year of their death and did not, the RMD must be taken for the year of death. As you can see, this gets really complicated really quick. It's also important, I didn't talk a lot about this, to be aware of the tax consequences. If it's a small IRA of a few $1,000s, there may not be a big deal. However, if it's somebody that's saved for a lifetime and died suddenly, it might be a big tax hit unless you do it right. It's probably still going to be a big tax hit, but it can be much bigger if you don't do it right. Because every time you pull money out of that IRA, taxes at a minimum are due and penalties may also be due. So especially, like I said, if you're subject to the 10-year rule, you don't want to necessarily be emptying that account in the last year. As you can see, this is very complex and missteps may have dramatic consequences. Always consult your financial advisor and your tax advisor. Get those folks working together prior to acting. This is part of the financial plan I do for folks. I help them deal with stuff like this because it can get real expensive if it's not done right. Once you graduate, be it from welding school, engineering school, or law school, you're going to need a different plan for each of these stages that's tailored to your individual situation. During your working years, biggest, most important question to ask early on is, am I saving enough and is it in the right place? When you get on that glide path to retirement, which I define as the last 10 years to retirement, will the USS retirement be shipshape on the appointed day? When you're in retirement, how do you avoid running out of money before you run out of life? And finally, your legacy. When you're done with retirement, does what you worked hard for get to where you wanted it to? They can be reached at herwirefinancial.com. I do in-person Zoom and phone appointments. I am licensed and registered across several states and can easily add states if there's a need. If you'd like to schedule an appointment, you can click on the schedule an appointment button in the upper right-hand corner of my website. If you want to see more videos like this, go to my YouTube channel. That's the red button, 2 buttons over from the schedule an appointment button. Please like and subscribe. If your friends want more information, they can follow me on Facebook, LinkedIn, or Twitter. For those who prefer the good old-fashioned telephone, my phone number is 518-631-2569. I caution you, do not text that number. You will be sad. I will be sad because I won't get it. There is a texting number there if you need to text me. Opinions voiced in this material are for general information only, not intended to provide specific advice or recommendations for any individual. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. Consult your advisor prior to taking any action. Unmanaged index returns do not reflect fees, expenses, or sales charges. Index performance is not indicative of the performance of any investment. Investing in stock includes numerous specific risks, including the fluctuation of dividend, loss of principal, and potential illiquidity of the investment in a falling market. Investing in mutual funds involves risk, including possible loss of principal. Fund value will fluctuate with market conditions and it may not achieve its investment objective. The Dow Jones Industrial Average is composed of 30 stocks that are major factors in their industries and widely held by individuals and institutional investors. The Standard & Poor's 500 index is a cap-weighted index of 500 stocks designed to measure performance of the broad domestic economy through changes in the aggregate market value of 500 stocks representing all major industries. NASDAQ Composite Index measures all NASDAQ domestic and non-US based common stocks listed on the NASDAQ stock market. The market value, the last sale price multiplied by total shares outstanding, is calculated throughout the trading day and is related to the total value of the index. Fairwire Financial and LPL Financial not endorsed or affiliated with the U.S. Centers for Medicare and Medicaid Services or any government agency. Hey, everybody, have a terrific weekend. I'll catch you next week.